So let's discuss in this video how it is that stock exchanges actually work. Again, something which you don't necessarily need to know when you're buying and selling, but important that we do have some understanding of how all of this works. Because we're going to be using some of the terminology as we go forward as well. So you have this exchange, which is this entity in the middle here, where what they essentially do is they find they match and find the buyers and sellers. In other words, those who are offering bid and ask prices. Those are, in other words, bid prices at which somebody is saying that's the price that which you can buy from them, and ask price at which you can sell to them. And they act as what's called a clearinghouse. In other words, they find all the buyers, all the sellers, and they match them together. They clear, and then they receive the money through a clearing bank in the middle, and they settle the stocks and deliver the stocks to the buyer. And what you have of the exchange are the members or the brokers, and these can be companies, they can be institutions, foreign and domestic, they could be individuals and traders. And what they do through an online terminal is place their orders into the exchange, like a big marketplace of where they're willing to buy and sell. And similarly, you have on the selling side sellers who also through an online terminal come to the middle and come to the exchange, and like a big, as I say, marketplace, they all trade, but they don't trade directly with each other. They trade through the exchange, so the exchange acts as the middleman or the facilitator and clears these trades. And what that ensures is that there's fair play between everybody, that it's all monitored, so nobody can say, oh well, you said this and no I didn't, and they all know what they're getting, they know when delivery is supposed to be, there's rules and regulations, so there's no cheating and there's no uncertainty, so everything works efficiently and in an orderly fashion. And there's set hours for trading, so somebody can't manipulate the market and try and fix the prices and do all sorts of bad things. And that's the role the exchanges play and the regulators around the exchanges. And of course, you're familiar with some of the biggest exchanges in the world, the New York Stock Exchange and the NASDAQ, London Stock Exchange. These are all largely now electronic, in that they very rarely do exchanges, the big exchanges around the world, have humans or on a trading floor. So NASDAQ doesn't, London Stock Exchange doesn't. They tend to just do everything through computers and people in their remote offices instead. The advantage for us as private investors of all of this is that we're now on a level playing field. Because there's no trading floor like before, where you had the information advantage if you were on the trading floor, the advantages to the institutions are limited. So we as private investors can tap into those computer networks, and that's what we want. But that hasn't made lots of private investors rich. What we've got to be able to do is not just that. We've got to move from there to having the skills and the strategies and knowing what it takes to make money. And that's my job, is to teach you all of that and ensure that with these changes that have happened, we can take advantage of it. So let me, in that regard, in explaining what the stock exchanges do, just fit in where a company or a stock fits into the sort of the broader economy. And I'm going to take you through this image. I'm going to start at the top left hand corner. All companies need money to start or grow their business. One way a company can raise money is divide itself into little pieces and sell pieces to investors through what's known as an initial public offering or an IPO, and each little piece is called a share of stock. Sounds very basic, I know, but the reason I want you to know this is because sometimes the things that are basic we don't know as private investors. Each share of a stock is entitled to a cut of the company's profits, that's the dividends, a distribution of a portion of a company's earnings to its shareholders. So the company has profits, it gives some as dividends and some as retained earnings. Retained earnings means it keeps them. A dividend is paid out to each of those stockholders. So look at these little bits here that the company had divided itself into, and each one of those stockholders gets a piece of that dividend and profit. When a corporation earns a profit or surplus, that money can be put to two uses. It can either be reinvested in the business or it can be paid to shareholders as a dividend. Many corporations retain a portion of their earnings and pay the remainder as a dividend. For a joint stock company, a dividend is allocated as a fixed amount per share. So it might be $1 per share. And the value of a stock is essentially determined by the principles of supply and demand. If people want to buy stock in a company X, the value will go up. Conversely, if few people desire, then its value will decrease. And a shareholder is just a partial owner of a company, and he also has a right to vote on who's elected to the board. That pretty much gives you a very good overview, moving from the stock exchange right down to the company level of exactly what companies are, how they're divided, all the key terminology as well. And of course, this is a grounding before we move on to, okay, what moves that value of a stock? And in this image, let's just look at this for a second. Over there, the broker, and I mentioned in exchanges earlier, a broker is the one who facilitates a trade between the two parties. When a stock is bought, the holder of that stock receives a stock certificate, and most traders just use the internet for paperless transactions, so we don't need to worry about paper, thankfully. And the broker, after the company sells the IPO, anyone desiring to purchase shares of the company must buy from them, from someone who wants to sell. This exchange is mediated by brokerages and exchanges, and fees are charged for doing that. So you'll have seen here now everything from exchanges to exactly how all this big terminology works that we keep hearing about stocks. It's very basic, I know. A lot of you will know all of this, but it's good to be reminded of the grounding in some of this relatively more basic stuff.